Hey everyone. So, if you've been brave enough to look at your portfolio lately, you definitely know the feeling I'm talking about. That little jolt of panic when you just see a screen full of red. The big question on everyone's mind is, is this just a dip? Is it a healthy correction? Or is this the start of something much, much worse? Let's break it all down and see if we can figure it out.
So this is the question, right? Is this the end of the road for Bitcoin and stocks? It's really easy to get swept up in all the headlines and the panic and just assume the party's over. But what we're going to do is cut through all that noise and actually look at what the data is telling us.
Okay, so our very first clue comes from how the market is feeling. Right now, the Fear and Greed Index is sitting at 16. That's not just fear, that is deep in extreme fear territory. Now that sounds awful, I know, but here's the twist. Major market tops, the big ones, they don't happen when everyone's terrified. They happen when everyone's greedy and euphoric. This level of extreme fear, historically, that's a sign you're actually closer to a bottom than you are to a top.
To really get to the bottom of what's going on, let's start where all the action is, the epicenter of all this volatility, the crypto market. Bitcoin's massive plunge is our first major clue in this whole investigation.
So let's float an idea here. What if this whole thing isn't the catastrophe it feels like? What if, and stick with me here, what if Bitcoin's huge drop is actually just a normal, even a healthy technical correction inside of a much bigger uptrend? So to understand these kinds of pullbacks, traders use this tool called a Fibonacci retracement. The idea is simple. After a huge run-up, it's totally normal for an asset to give back some of those gains, and this tool helps pinpoint where it might stop falling. And you know what? That zone between a 50 and about a 61.8% pullback is a classic textbook spot for support. And guess where Bitcoin bounced? Right in that zone. See, that looks a lot less like a collapse and more like a bull market just taking a quick breather. Okay, fair question. If this is also normal and textbook, why did it feel like the floor just completely fell out from under us? The speed of that drop is what really freaked everyone out. And believe it or not, there's a very specific mechanical reason for that.
The answer, in one word, is leverage. The moment Bitcoin broke through a key support level, it was like a tripwire. It triggered a massive flood of automated sell orders. This just created a domino effect, a liquidation cascade that forcibly sold an estimated $11 million in long positions. That forced selling is exactly what turned a normal dip into a stomach-churning plunge.
So all of that actually gives us a really clear level to keep our eyes on now. The whole panic started when that 98 to 99,000 zone was broken. If Bitcoin can get back above that level and hold it, that would be a huge signal that the worst is probably over and a bottom is forming. So that's the zone to watch.
All right, so that's the story in crypto. Now let's shift gears and look at the stock market. Is the S&P 500 telling us the same story, or is something a little more sinister going on over there?
To really get a feel for the stock market's health, you gotta look under the hood. The S&P 500 you always hear about is market cap weighted. That just means a handful of giant tech companies have all the influence. But if you look at the equal weighted version, where every single stock gets the same vote, you see a totally different picture. The average stock isn't crashing at all. It's just kind of moving sideways.
And this quote just nails what that chart is telling us. This doesn't look like a classic market top where everything just rolls over and dies. No, it looks like a consolidation, which is basically a fancy way of saying it's a pause. It's the market taking a breath before it decides where to go next.
But what about the big kahuna, the market leader, NVIDIA? Well, even here, we are not seeing a breakdown. The stock is just trading back and forth, sideways, in a really well-defined range, bouncing between support and resistance. Again, this is consolidation, not a collapse.
So if the charts for both crypto and stocks are basically saying this is just a correction, then what on earth is driving all of this fear? Well, for that, we have to zoom out and look at the big picture. And that means we have to talk about the Federal Reserve.
And here's the culprit. Just last week, the market was almost certain that we were getting an interest rate cut in December, but then a few Fed officials made some comments, and boom, that probability just plummeted. It's this sudden, sharp change in short-term expectations that has really spooked investors.
And the bond market, what people often call the smart money, is basically screaming that this shift is real. What we're looking at here is the gap between the 2-year Treasury yield and the Fed's current interest rate. Last week, that gap was pretty wide, signaling, hey, a rate cut is coming. This week, it got sliced in half. The bond market is now saying a December cut is pretty much off the table, and that's what's making the stock market so nervous.
But listen, this is probably the most important takeaway of all. While the timing of that first cut is now up in the air, the overall direction hasn't changed one bit. The long-term trend for interest rates is still pointing down. The market is basically throwing a tantrum over a delay of a few months, but the big picture, a future with lower rates, is still completely intact. Okay, we've looked at sentiment, we've looked at the technical charts, we've looked at the macro picture, we've gathered all the evidence, so let's put all these clues together and deliver the final verdict.
So to wrap it all up, we have sentiment at extreme fear, which is usually a sign of a bottom. We have Bitcoin's drop looking like a textbook correction that was just made way worse by forced selling. The average stock is just chilling, moving sideways, and this whole panic seems to be a huge overreaction to a shift in the timing of Fed cuts, not a change in the ultimate direction.
So the conclusion from all the data seems pretty clear. It looks like we're in a corrective phase inside of a larger, ongoing bull market. This is not the beginning of a collapse. The main thing driving prices right now isn't some fundamental breakdown, it's just too much fear.
And that leaves us with one final, and I think really crucial question to think about. When fear is this high, but the underlying trend still looks healthy, is the real risk really about prices falling further? Or is the bigger risk being so paralyzed by that fear that you end up missing the next major move to the upside? Something to chew on. Thanks for tuning in.